Does anybody remember
Really fast.
Pokemon Go? How fast that took off?
Absolutely.
Oh,
Like,
here, hold on, Clint. Clint,
Jeez.
great story, great Pokemon Go story. Okay, I'm sitting in a restaurant on 57th Street and 6th Avenue. Okay, sitting outside, and all of a sudden, I swear to you, I swear this is before COVID. There's maybe like 2018, right? It's whenever it was big. I'm not
18,
kidding.
19. Yeah.
Yeah, it was like an army of people, 300 people running full speed down 6th Avenue towards the park, towards Central Park, at full speed. And they're like, I saw one guy knocked over somebody, cars are stopping, like they're crossing 57th Street and the light's green and like cars are, like taxis are coming to a screeching halt. They're all going out. I'm like, what's going on? And they're like, some super level Pokemon's in the park. And they're like running to the park.
Yeah,
Pokemon Go, man.
Living in New York when Pokemon Go was on was just such a strange thing because you just saw people around Central Park taking pictures of nothing. It was so hot.
Okay, I'm gonna hit it. Hey everybody, welcome to This Week in Pre-IPO Stocks podcast. With me, we got Nick Fusco, CEO of 8View, a pre-IPO secondary market pricing company, Clint Sorenson, Chief Investment Officer at WellShield, an outsourced CIO and investment research company, and a very special guest today in Mr. Chris Nero, CEO of Bridgeport Financial Technology. It's a digital private investment platform for wealth managers and alternative investment managers. Mr. Nitti couldn't join us this week. He had some personal items to take care of. So we got 3 topics to hit on today. We're going to talk about Shein's new capital raise. We're also going to talk about Silicon Valley Bank getting absolutely crushed in the market today, and Epic Games powering Lego's metaverse. Okay, just to kick us off, first topic here. So Shein, I don't know if you guys know this company, but they're huge. This is like another one of these big shops out of China that I think a lot of folks don't really talk about. But Shein's an online clothing company. They're headquartered in China, but they recently moved to Singapore, which is interesting because that's a developed market. So they're technically headquartered out of Singapore now. So developed market company. They have 74 million customers, 13 million in the United States, and they don't sell any clothing in China. Okay, so these are all global customers. 23 billion in 2022 revenue. They last raised $1 billion in October of 22 at $100 billion valuation. They got Sequoia China in there, Tiger, General Atlantic, Brookfield, and they're rumored to go public in the U.S. in 2023. Okay, so gentlemen, have any of you ever bought fast fashion from Shein? Anyone?
I bought an A.G. Dillon hat on there last night for 25 cents.
Bestseller. Oh, I thought they were giving them away. I love it. No, the stuff's on there very cheap. I've never bought anything. It's very cheap.
Yeah.
It's like $10 for like a shirt or something, right? My wife hasn't bought anything on there either, but 13 million people in the United States have. It's a fascinating model. The only thing I've read about them is they kind of like steal designer designs, right? And I think the last thing I read too about them is they put stuff on there, they haven't made it yet, and then people buy it and they hurry up and make it and ship it out. So it's this very interesting kind of production model that they have as well. But
I mean, that's brilliant in the first place. But I mean, that nature of stealing designs is pervasive across all the fashion houses, right? I mean, when you look at H&M and Zara, which you definitely throw in the fast fashion area, you're definitely seeing them pulling runway styled fashions and getting them done for cheap. I mean, we're Aaron, you and I are sitting in New York, so we have access to those if we need. So we're not necessarily doing as much mail order. I don't really do mail order clothing, but clearly it's been massively growing with everything moving online. Even with the advent of like Rent the Runway and then it going a little bit more down market. So, I mean, this makes a ton of sense as a concept. Do it cheap.
Yes.
Where you can get the product created. Love the idea of design and then eventually create. But yeah, that drop from October is pretty massive. That's well beyond what we're seeing in the markets. We saw your your kind of broader stocks moved down about 12% in the last 6 months. So this coming down 40 is pretty extreme.
Yeah, that's steep. I mean, now that these guys are in Singapore, I mean, technically they qualify in my investment thesis now, right? So they're like my math has them at somewhere in they're in the top 5 of the largest pre-IPO stocks globally, right? So, I mean, Clint, maybe let me ask you this, what are your thoughts on investing when we talk about investing in private tech companies, like domestic versus international? Are there certain countries you want to stay away from? Do you want to stay away from all the international holding companies, just focus on US? What are your thoughts on that?
I mean, probably Russia I'd stay away from, but other than that, I mean, no, I mean, I think one of our big themes is this whole international over domestic. If you just look at those markets from a broad perspective, they're a lot cheaper than the US, right? And if you think about the way the world's kind of shifting to this deglobalization, right? Everything, onshoring here in the US, everything kind of getting separated. It makes a lot of sense that you're going to get some idiosyncratic risk in these other countries and other areas. And that, from an investment thesis to us, makes a lot of sense. So, I actually like this type of company. I haven't dug in enough to know, what's its, how profitable could it actually be? But anytime you're serving the masses in something like this, that you're adding value to these people, or you're helping them in terms of their quest for status, which is a large reason why people buy things, especially fashion. And if you can do that well and deliver it and continue to execute, I mean, they've got a ton of customers. I mean, I feel like this is a really good business model on the surface, and I really like this environment. Like I said, serve the masses, you live at the classes. Serve the classes, you live at the masses. So I really like this business model in general. But no, I love international. I think we have to, especially in the U.S. If you think about the percentage of GDP that is international versus domestic, it's a huge percentage. And most U.S. investors have the majority of their money in U.S. companies. And with deglobalization, right, you're not going to get the benefit of these multinationals continuing to earn 60+% of their revenue streams overseas. It's going to be a little bit of a shift, and there's going to be a rise in competition from these international companies that are domestic to their country. So I think investing in some of these makes a lot of sense, just like it does in the public markets.
Right. Okay.
So Aaron, question for you. What do you think about valuation? I'm two questions. Is this a tech company or an e-commerce company, right? Yeah. And if you look at valuations, at least in e-commerce, right, they're like 3.5 to 6 times revenue. This is under 3 times revenue, this recent valuation, 23 billion in revenue and $60 billion valuation. So is it cheap or is it pricey? I mean, it still looks relatively cheap. That is a 40% markdown from October. Right.
Yeah. I mean, look, if it's a retail company, I think you're right. I mean, if you probably asked the folks over at Shein, they probably hold themselves as a technology company, right? So 3x revenue is really low. Right. I mean, if you think about the other companies that are in like the top 5, top 10, their revenue multiples are significantly higher than that. Like a Stripe, right? I mean, SpaceX is a 30x revenue multiple. I mean, that 3x revenue multiples, or sub 3x revenue multiple, I think is really low.
Yeah, curious what you guys think of the comparison to Domino's Pizza. When folks thought about Domino's as a pizza restaurant, it was a very low multiple. When they started to reclassify themselves as almost a logistics company, right, it went through the roof, and that was in the last few years. So in a lot of ways, I kind of look at this the same way as AG. I mean, 3x, that is cheap.
It's cheap. It is cheap.
Yeah, I mean, especially with only 14 million customers in the U.S., you'd have to imagine that if it catches on here, that it could expand pretty quickly, right? But I mean, but Chris, you see a lot of deals. I mean, you're learning a platform, right, of alternatives. Right. You know what I mean? Are you seeing deals coming strategies that are investing into Asia or into kind of non-U.S.? Like, what's the kind of the pickup on those versus more domestic focused strategies?
I don't think it's any specific. It's not specific to any particular region at the moment, right? I mean, I think going back to what Nick said, for sure, just as we look at valuations dropping, right? You're seeing people starting to go in and books are getting marked, right? As of the end of 22. And the write-downs seem to be in the range of 20-ish, plus or minus, call it between 15 and 25. Obviously, it depends on the business, but 40 in this case seems pretty steep. Right. And so quickly, I mean, that valuation was October of 22. So,
Right.
it's pretty steep.
Yeah, I got to tell you, these are one of these companies where you feel like it might be a buy, right? I think that's kind of, to your point, Nick's point. It's, but look, a lot of these pre-IPO tech companies got beaten up pretty bad, and some of them have incredible performance, right? So it's almost at what point, I know we got a trend follower here on with us, so it's like almost one point to the signals turn, right? And you start to buy. But
well, I saw something
what do you
today.
think,
It's all
Brian?
about liquidity, right? I mean, if you think about it, we have M2 on a rate of change perspective negative, right? Since 1959, that's happened 0 times on a year-over-year basis. You start to go back. The only times you have, and this work comes from Dr. Lacey Hunt, if you look at his model that goes back to the 20s, like the only other time this has happened was like 1929 and 1930. So we're not in good company here. You got major liquidity draining out. And when you've had an environment of a lot of liquidity and the flow of liquidity constantly up, when that spigot runs dry, all of a sudden, any company that's reliant on credit, which is almost every company you can possibly name in the startup space, when that credit engine ends, there's a problem. The credit has to keep flowing. It's not about the absolute level. It's about that rate of change, and you have to have an increase in credit. The credit cycle leads the market cycle, and which sometimes leads the business cycle, right? I mean,
Okay, so that's a good point. So then if you wanted to get an allocation in the space, you're probably thinking what? You want companies that are profitable, so they don't
profits
have to
over
dip
promises.
into the
First thing you got to look at.
Right.
Yep, they have balance sheet strength, and they got a lot of maneuverability around excess costs, and they've got a trajectory to rising margins.
Yeah. And also, I'm assuming, I mean, these are high growth tech companies, right? So if you can see somebody that's throwing up double digit gains or more, high double digit gains, those are the winners that you
Absolutely
be looking at, get exposure to.
Absolutely.
All right, cool. All right, gentlemen, let's shift topics to what I think is going to be a gangbuster here. SVB. Okay, these
Clint,
guys.
where's the balance sheet strength
just
here?
got absolutely crushed.
I'll let Chris opine on this balance sheet strength.
Yeah, yikes. Well, it's interesting, right? When you look at the numbers, right? I'm looking at the sheet, the last sheet we were looking at, Aaron, that you sent over. I mean, 56% of their loan portfolio is PE and VC capital call facilities, right? And so those are, I would view those to be, fairly safe. I mean, they're really syndicated across the LP capital commitments, right? And so they're really relying on the credit of those investors, right? So regardless of what's in the portfolios, I mean, those tend to be pretty secure. I mean, this indicates one net loss since inception. We've talked about this before. We did a lot of lending to large fund of funds and hedge funds at Deutsche Bank. I mean, I think in 3.5 years, we saw 0 defaults. You don't typically see that. And so when you look at that, and again, I don't know this loan data they're showing, I'm presuming that's based on dollars, not number of loans, right?
Yeah, I think
so
that's
56,
right.
56% of the loan book is there. That looks reasonably safe. The one thing that obviously I think jumps out at all of us is they've got about 9% in venture debt, right? And we all know how the venture debt works, right? That venture debt is wholly contingent upon that company's ability to raise the next round, right? And so that dynamic has changed dramatically, right? Yeah, they can raise the next round, but at what discount? Like we just saw, right? At a 40% discount. And they're also looking at when they issue those loans, what's the likelihood those investors are going to step back in and put more money up, right? And so those dynamics have all changed dramatically. So, the question is, so to me, that 9% is the biggest red mark here.
Yeah, I agree.
Right?
I agree that, but this was telling to me too, right? This was on one of the later slides that came through on that same investor presentation, but $76 billion of outflows since Q1 of 22 for their clients. That's 5 consecutive quarters of outflow, right? So that's like stark contrast to what was happening. I mean, what is interesting is how much money was coming in.
Right.
right. The year before. So you'd have to imagine you're just cycling through some of that, but it's brutal. I mean, the stock was down 60% today. So the market obviously doesn't like it, right, wrong, or otherwise. But I mean, first of all, I feel bad for the people at Silicon Valley Bank. Their stock, so the poor people working there are probably working the tail off, especially right now with everything going on, and then they get slapped in the head with with a 60% down in
In a
one day.
day.
That's tough to swallow.
Yeah.
Yeah, that's
and
tough to
is.
swallow.
just for anybody that's listening and not seeing that screen grab, I mean, it was a nice mountain peak and then came back off. But I think that really looks like a lot of the outflows and inflows into these customers that they have, right? If you really think of the capital allocations into
That's a good point.
every stage of venture, it's almost a mirror image of that. So if
That's a good
you have a
point.
lot of these companies that are beleaguered, it's going to reflect back to the bank because their highest concentration of customers is kind of the growth stage market and a bit below of what we're looking at. So
But this
it
is-
shouldn't be a
this-
huge surprise, right?
And you can plot
don't-
him too over it. Going back to the credit cycle, right? I mean, if you think about the longest duration asset you can invest in, it's innovation, it's venture. And so you're growth, right? And so you're essentially, if you just plotted M2 year-over-year percentage change, it's going to match their inflows and outflows.
Right.
And it's just unfortunately a function of the cycle. We're all kind of falling victim to the Fed's wrecking ball and the fact that they continue to tighten into an economic slowdown when M2 is already contracting. And as long as they're doing that, this is going to be an ugly picture for Silicon Valley Bank or anybody else in the venture space.
Right, but how many more
Yeah.
banks look and feel like them? They are.
Silvergate
not many.
and see what's happening to them, right? I mean, they kind of concentrated specifically on crypto, but that's another one, and they've been just destroyed. And now there's a whole lot of allegations floating around. I'm not going to steal people's thunder on that, but I mean, there's a short army moving in on Silvergate Bank, and there's a lot of potential shenanigans that are being exposed there. And this is again another function of the credit cycle. If you think about what happened in 07, 08, it's just a different sector. This time it's crypto and venture. It's really duration.
So this is my question. So Nick, let me ask you this, and I'm sure you guys, other guys, will have a thought on this. So if this stuff seizes up, if this, this to me, I think like what comes next, right? So this just happened, right? So naturally, if I'm a banker, everybody's pulling back from venture debt at least a little bit, right? They're just going to naturally get more conservative. They're bankers, right? So they're going to get more conservative after this happens.
I don't know if I'm going to agree, but yeah, I'll follow you down the rabbit hole on this.
Okay, well, so that's my thesis, right? So maybe the thesis is wrong. So you tell me what you think of that. But if that's the case, then maybe some of these companies that need capital are going to have to tap the equity markets, which means they're going to be hitting the markets at lower valuations, where they were funding themselves through debt to kind of get on the other side of this downturn to go and and bring in the equity and kind of bring down and manage their balance sheet that way. There may not be that type of opportunity now going forward, right?
Yeah, I traditionally looked at it as a lot of the companies that were tapping equity throughout are now tapping debt. So they're not getting hit as hard with that down round because there are all these extra terms and structures built into it that investors aren't going to necessarily see the same dynamic, and they're not getting clobbered in the public view. But I also kind of think you might be right. I mean, you traditionally have a lot of, let's say, health tech type companies that finance via debt, and maybe they haven't tapped an equity round in a very, very long time. So they can discreetly do some of that. Maybe it goes both ways. I didn't really think of the latter, but I do think you might have a point there. But I do not think venture debt is going anywhere. I just think that market's going to keep getting bigger and bigger as time goes on.
Well, it's just I mean, imagine you're a CEO now. I mean, interest rates are going to go up. I think risk premium is going to increase after this too. So now you have this decisions like, do I want to pay this very high rate, perhaps, right? Or am I willing to? Maybe we just bite the bullet and go to the market and do a round.
I would do debt, right?
Even
if it's expensive, right? I mean, this is.
Absolutely.
I mean, you do debt and you say, okay, eventually this is going to break something. The credit cycle is going to turn. It's going to have to. And so if you've got the ability to borrow at anything reasonable, I think you borrow here. Chris, what are your thoughts there?
Oh, absolutely. I mean, just look at the change in the cost of capital. I mean, even if rates are double what they were 12 months ago, think about if you do a down round, right, at half the valuation, you're going to get crushed.
Right.
Absolutely crushed. And so I'm curious too, when I'm looking at these numbers, it's like, okay, what what is the structure of that debt? What's the timing of it, right? Because typically, excuse me, what you're going to see now is, people are going out. Silicon Valley Bank was probably doing maybe 12 to 18-month structures. So the question was, how is that structured? Is it amortized, mortgage style? Is it interest only for a period, right? And so it'll be interesting to see, what the dynamics of that are. So I don't know.
But look, guys, I got to tell you, if I'm a venture capitalist, though, I'm putting equity into a company, and I guess it depends on the stage of the business, right? I mean, I don't want that to just like, I'm going to write you a check, and then you're literally going to take that money and pay off a loan.
Right.
Right. I mean, like, what's driving the growth? Like, I mean, I guess if they're already driving growth, then maybe it's no problem. But if you're telling me you need capital to grow, you're now like massive dilution when you do go back to the markets to raise the money. Right. And I don't know, like if it's a later stage company, you're probably just,
that's what I'm saying. They got balance sheet flexibility.
Right. Later stage companies, but these earlier stage companies.
That's
right.
But Aaron, you raise a great point, right? If you go to investors today and say, look, our valuation cut in half, we have 5 million or 50 million in venture debt, right? So we need to raise another 50 at half the valuation to pay off our debt. How many of them are going to participate? I mean, right? I mean, now the other side to that is if they don't participate, what happens, right? The collateral gets taken and they lose their equity. So the investors aren't in a great place either here.
Right.
So it's
but
gonna
that's
be
where
interesting.
like I guess that's where I'm like I feel like there's just got to be balance. Like you can take the debt, but you got to be thoughtful about how the stuff relates to each other, right?
Right. Yeah.
Yeah.
Go ahead, Chris. Sorry.
No, go Nick. Go for it.
Yeah. So I think we chatted about this either a week ago or 2 weeks ago with the structure and the waterfall, looking at the common A, B, C, D, all the preferreds. When you layer on the debt component, right, and you think about, you know what, now they just, no matter what, instead of doing that down round and the liquidation preference is different, or depending on how they want to structure it relative to the prior one, no, all that debt is getting paid back. And the common holders are really the bag holders. And think, who are the biggest common holders in the company? It's going to be your employees. So this is a very delicate situation. Once you layer the debt piece in, and the staff start to get wise of what's going on to their common shares. Maybe it's okay with an IPO, but with an M&A, like shit will hit the fan pretty quick. You can edit that out. Sorry.
It's a good point. And if Don was here, he'd be like violently agreeing with you. Right? I feel like every week he brings up preferred and liquidity preferences, right?
Yeah,
and
but
rightly
it is such a
right?
big deal that I believe a lot of the market is ignoring, except for the really savvy investors that have been in it for a while. But some of the newcomers are just wrapping their heads around it. And some of the real great sharks that understand credit are going to make great returns here as the market changes. Look at GA. I think GA is going to walk away very well out of this, right? With
Silicon Valley Bank.
Yeah, with SVB.
Well, what's interesting, all right, so what's interesting, if I read this correctly, I actually think all of these things price at end of market today. So they're going to get in. They're going to get the number, the share count's going to get calculated at the 60% depressed value. So good on them, man. I think you're right, Nick. They're going to be okay.
The sharks.
And I'm sure there's something dubious going on behind the scenes, and that's
come on, who knows?
Over shorted today.
Yeah, exactly.
Yeah, man.
Call up all their buddies. Well, hey, I need you to short this real quick.
Yeah.
Well, specific to that liquidity preference and the preferred that they had 500 million preferred. It was the liquidity preference was $1,000 a share, to like $160 now. So man, like the preferred, you got to keep your eye on it, right? All right. Okay, let's talk Epic Games and Lego. All right. So Lego invested $1 billion. The family did that owns Lego. Lego's private. Invested $1 billion into Epic Games in April 22 at that $31.5 billion valuation. What's interesting is so Epic was at like 28 billion in 21 when they did a raise, and then they did 22. So it was up, but they had some big secondary market trades that were going in like the $45 billion range, right? So do you call that down? I mean, on the primary it was up, but if you look at the secondary, it was way down, right? This number that came through. But I'm assuming that this is this metaverse announcement that they have. This was part of the deal that they put together in April, that this metaverse announcement between Lego and Epic Games, so it's going to be powered by Epic Games Unreal Engine, right? Is going to be like a Minecraft competitor. I don't know if any of you guys play Minecraft, right? My kids do, and it looks a lot like Lego. I'm not going to lie; they're always building stuff with like these bricks and stuff, right? So it's I have to imagine that's a big success. I think Microsoft owns Minecraft, if I'm not mistaken, right? So that I can see this kind of be an Epic Lego competitor to that Minecraft enterprise, But I guess the question is Nick, do you see any other brands, creating these metaverses? I mean, maybe Lego's special because of this, the bricks and the concept of who the business is, right? You create things from nothing, right? With these, smaller units, these bricks. I mean, do you see other places out there where other brands that might have a metaverse that could mirror something like this or have an impact on their business?
Yeah, so that's interesting. And I think you guys have kids that are older than mine, so honestly, I think they are going to lead the trends, and they're going to be our best feedback loop. But I kind of feel like there are many, but they're all so much smaller that they're not going to have the edge. Where you come up with Microsoft, Epic, Lego, these are monster household names, and I think with regards to the metaverse, a lot of it is critical mass. So when you come at it with critical mass, I think that's why this is going to be a fierce competitor to what Minecraft has. I mean, even if you switch on YouTube, it's going to suggest all this Minecraft stuff, and I don't even know what Minecraft is, barely.
Yeah.
So I think the popularity of it is absolutely outrageous. So I would love to just hear how many hours are being drained into this creatively from children. And I feel like that's a very good indicator. And are they using second or third tier type metaverses? Kind of doubtful.
Well,
because
so the crazy thing, my kids, if I don't tell them to get off, they're on for all day. But then they're always hitting me up, Nick. Like there's grown adults that are building like universes in the Minecraft metaverse, and then you can like pay to buy that or get access to that, that universe. I'm probably not saying the words the right way. So my kids are always trying to hit me up for, a couple bucks to buy some new thing.
Yeah. I mean, pay and play has been around for a long time. Think of the guys at Blizzard, right? With Warcraft and that franchise, World of Warcraft, billions of dollars spent in game, right? But again, it's an ecosystem that's already there with an established player set, and it's not winner take all. I feel, but I think it's highly acquisitive for the big guns to take out the little shops before they can grow any sort of critical mass, right?
Lego's.
I think it's a brilliant.
They did the movies, right? Yeah, go ahead.
I just think it's a brilliant strategy by Lego. I mean, we talked about this on our metaverse episode when we discussed the metaverse, but Epic Games has the most mature metaverse in existence. They throw concerts on Fortnite where huge amounts of people show up. And if you think about this is a race. This is a race to grab community and to benefit from the network effect. That's what this is. And Epic Games is leading that race, in my opinion. And I think it's a brilliant strategy by Lego to piggyback and borrow credibility from their established community, to Nick's point, and just keep going, right? I mean, think about what this opens up in terms of NFTs, collectibles, right? Events. Like Lego moving into the movies, established that was a brilliant move, Aaron, as you mentioned.
Right.
Now they're moving into the metaverse. They're going to continue to get stronger. This is, I think, in my opinion, I think this is a great play for them. And Epic Games, it's smart. Epic Games is like, instead of us just trying to control the metaverse, let's power it, right? Which goes back to the centralization, decentralization argument. But they're winning. Centralization's still winning. And Epic is winning this race right now. It's not Meta.
Yeah.
It's not Sandbox. It's not any of the other ones, even the decentralized ones like Decentraland or Sandbox. But it's Epic. Epic's winning this race.
Okay. So that to that point, right? So Chris, when I think about Epic Games and what they're doing with the metaverse and what Meta, right, like in the plans that they've announced, I mean, do you have any opinion? Do you think those are the same thing? Are they different? Do they have different kind of target customers? Like what do you think about kind of Epic versus Meta on the metaverse?
You know what? It's funny. I'll talk about my own kids have graduated from, onto Fortnite and onto girls now. So I haven't been following it that much. But
Fair point.
yeah, now I just follow them on their phone and try to figure out where they are at night. So it's been a while for me.
I got it. Yeah, man.
So Aaron, my metaverse looks a lot different than yours does right now.
Understood. Well, the Meta stuff. I mean, I had a buddy who works at Meta swung by the office the other day, and she was like, "Look, we got the new goggles coming out. It's all focused on businesses, right? So like Meta is all about like communication, all about and I'm sure there's going to be some personal stuff in there, like have dinner with your family that lives across the country, like those kind of things, right? Like Chris, to your point, like your kids are away, you could throw the goggles on, you could like have a conversation with them like literally in the same room. I mean, she was even telling me that you could see through the goggles, and there's almost like an AR aspect, like augmented reality aspect to it, where they would be like in the room with you. It's like Star Trek stuff. It's crazy.
But same in the medical community, right? I mean, you've seen commercials, right, where they're actually examining somebody's knee or looking at X-rays right through the metaverse. I mean, it's pretty amazing.
It's powerful. So like that's like Epic seems to be coming at it more from like an entertainment perspective, perhaps, right? At least the deals that I've seen them do. Where Meta's coming at it from more of a what I would say like business and personal experience, right? Like more like a real world, if maybe that's the right way to think about it. Where I mean Epic Games is like even their metahumans that Epic Games has, I mean those are like computer generated first, right? Where Meta's even talking about photorealistic avatars and some of these other things, right? So it's like two very different approaches to the technology. But I mean, I don't know. Anybody have any strong opinions on what's gonna? I mean, Clint, you said like Epic's winning now.
Yeah,
but
they're winning in terms of community, right? And I think that's where you get the biggest bang for your buck. So they're going to be an established player for a while, and gaming is not going away. And they're going to always get the younger folks to partner up. I think that from an enterprise perspective, Meta's winning that race, and obviously from a hardware perspective, and I think Apple will start to play in the hardware into the game too, right? Maybe I've heard rumors about suits and things like that. So I think you're going to continue to see those two players do well, and then I think Microsoft steps up in the enterprise and business community as well. It'd be better for Microsoft to partner. I always thought it'd be better for Meta Facebook to partner with a decentralized metaverse so that they could be a purist, buy that community and then really start to develop within that community, but they went a different direction. But I still think they're going to be a player. I think all three, Microsoft, Epic Games, Sandbox or Decentraland or maybe both. I think you're going to have a lot of metaverses. And I think about just like when we were growing up, you had PlayStation, you had Nintendo, you had Xbox. I mean, it's very similar. You're going into this alternate reality to do something. Now it's just being blended with what we do on a day-to-day basis from a real perspective, work, right? Play, family obligations, communication, etc. So I think there's plenty of room. I think it's one of the biggest things we've seen, period. And I think it's great. But yeah, I think you nailed it when you said it's different audiences, right? And I think you're gonna have your business audience, your family audience, probably are gonna gravitate to where they sit, which is on Facebook or wherever. And I think your gamers are gonna, your younger crowd, they're gonna go to Epic because they like Fortnite. And they go to Travis Scott concerts on Fortnite.
Yeah, that's true.
What about, and just to throw the curveball in here, but got this from the guys at Convoy VC, looking after kind of early stage gaming. But what about Apple? So Apple dropped a bomb back in January. They're coming out with augmented reality, $3,000 for the headset. I mean, I don't think they are going to get hurt by not having a first mover advantage. That's an outrageous brand to enter the ring too. I think when the four of us have this discussion in 6 months, so I think it's coming in the spring, this could be very interesting. So I definitely say we got to readdress this topic and bring Apple back in the mix and see what they've come to offer.
I love that.
I mean, they haven't come out with too much amazing stuff from the iPhone as of late, because we used to really look forward to Steve Jobs coming out and saying, like, look at this.
Yeah.
But this could be
yeah.
absolutely revolutionary because they keep a lot of things pretty top secret before they launch, right? So
Right.
Right.
I'm just excited
Right.
for that. Not to
I'm waiting for the
digress from
contacts.
Epic.
Nick, I'm waiting
Oh,
for
God.
the contacts. Right.
That's for
That's what-
next generation. If
That's
it
what I
happens for
want.
our generation, fair enough.
No, man, I gotta tell you,
don't know.
there's companies right now with functioning contacts for augmented reality. Like we'll have those in 5 years' time too.
Unreal.
This stuff's happening fast.
Do you remember
is
Pokemon?
happening
Does
fast,
anybody
really
remember
fast.
Pokemon Go? How fast
Oh,
that
yeah.
took off?
Absolutely.
Oh,
yeah.
Like,
Here, hold on, Clint.
Jeez,
Great
man.
story. Great Pokemon Go story. Okay, I'm sitting in a restaurant on 57th Street and 6th Avenue. Okay, sitting outside, and all of a sudden, I swear to you, this is before COVID. There's maybe like 2018, right? Whenever it was big. I'm not
18,
kidding.
19. Yeah.
Yeah, it was like an army of people, 300 people running full speed down 6th Avenue towards the park, towards Central Park, at full speed. And they're like, I saw one guy knocked over somebody, cars are stopping, like they're crossing 57th Street and the light's green and like cars are, like taxis are coming to a screeching halt. They're all going out. I'm like, what's going on? And they're like, some super level Pokemon's in the park. And they're like running to the park.
Yeah,
Pokemon Go, man.
Living in New York when Pokemon Go was on was just such a strange thing because you just saw people around Central Park taking pictures of nothing. It was so hard.
It's coming, man.
Yeah,
it's coming. It's all
That's
coming.
better than
very,
the
very
metaverse to me. I'm more of an augmented reality guy. But
I think that's gonna hit. And then, like I said, my buddy my buddy was saying that they're gonna layer in the metaverse into the augmented reality.
Right.
Like that stuff's pretty cool too. So, okay, gentlemen, let's end it there. Anything else? What's on your guys' mind? Anything else you guys want to hit on this week? Okay. Well, listen. Special thanks to Mr. Chris Nero for joining us today.
Yeah, thanks for having me.
For us.
Lot of
Appreciate
fun.
you, man. Appreciate you, man. All right, gentlemen.
see you
You
guys.
guys take care. Have a good week.
Okay, guys.
you.
Thank you.
Bye.